It is my pleasure to introduce Senior Associate Director for Commercialization in the Office of Technology Commercialization, Eric Hartman, to talk about the death of the LLC. Welcome, Eric.
Thank you, Jackie, and hi, everybody. So glad to have everybody here today. So I want to start just by saying or acknowledging there's been maybe some people that were a little confused with the email announcement about this webinar and the death of the LLC. I understand that at least a couple of people saw it and thought that it was announcing the death of me. So if you're here for my memorial, then I apologize. I'm still alive, and hopefully that's not a disappointment, but maybe it is. So we'll get started here. Also, if you're here for a lighthearted stand-up comedy routine today, you're going to be disappointed as well. So we are getting ready to do a deep dive into a very complex topic of startup entity selection, but it's also a very important topic and definitely an important topic for long-term value creation in startups. So glad to have everybody here today, and let's jump right in. We've got a lot to get to. So I want to start with a disclaimer, and that is that this presentation is for informational purposes only. I am not an attorney. I'm not providing legal and professional advice. What you will hear throughout this presentation is me strongly encourage you to go get a very, very good startup attorney and to get excellent quality legal advice. The goal of our session today is to help inform some of those conversations as you approach your attorneys and your accountants and other professionals that you may be working with. And hopefully you will be in a position to ask great questions at that time and really get the advice that your company needs to make the right decisions. So as we think about this topic and also the topic and the title of the topic, I think got some people's attention in terms of, well, is an LLC always a bad thing? And so I think I want to start this with a description and really a framing of the audience that we're talking about and the type of startup that we're talking about. And within the context of the right audience, I feel very comfortable in saying that the LLC is not the right choice, and hence the title. But certainly there are other cases where it could be an appropriate entity selection. I want to talk about those. So let's jump in and talk. So as we do this, we want to begin with understanding the purpose of a startup. And so the purpose of the startup is really all about defining the audience that we're looking for. So when we're with the university talking about commercializing a technology, translating a technology out of the university into a startup, or through our Launch Blue program, working with community startups that are looking to scale and exit with investor funding and things like that, there's a very specific purpose and track that these companies follow. So I want to begin here with the definition by Steve Blank of what a startup actually is. So Steve Blank, for those that don't know, is maybe the patriarch of the modern lean startup movement. And he defines a startup as a temporary organization that's used to search for a repeatable and scalable business model. The key word there for our purposes today is it's a temporary organization. It's an organization that's founded with a mission to take a technology, to take a business opportunity from a point where it is today to another point at some point in the future where that company can exit and exit usually via acquisition by a larger corporation. Sometimes that exit happens in other ways, such as via an IPO, but the vast majority of time it's happening, it's a scale and exit via acquisition type of a business model. But it's a temporary organization that's designed to take something from point A to point B over typically a fairly short period of time. When we talk specifically about university technologies or deep tech or hard tech, tough tech, things like that, we might think of it as a little bit different. There may be some cases where we're not searching for the repeatable and scalable business model part, but it's still a temporary organization, in this case, that's designed to de-risk technologies and position them for acquisition by a corporate. Typically, de-risking that technology requires the formation of capital, investor capital. Could be non-dilutive capital as well, but particularly dilutive investor capital. And that's going to be a large part of the influence of this talk today, is the assumption that these startup companies are trying to secure investment capital. They're going to scale and they're going to exit via acquisition. The other thing that the startup purpose does for a deep tech company is it provides flexibility. So from a legal perspective, you need to be able to enter into various agreements. You need to be able to do business. You need to be able to work with your customers. You need to be able to in and out license certain technologies. You need to be able to set up things like quality systems if you're in the medical space. All of those things are very difficult to do within the confines of the university, and therefore there's a need to take that technology and move it into a startup where you have the flexibility in that corporate entity to be able to do those things that you need to do. And then from a branding perspective, we see this with the university as well as even in corporate America. When they want to try something that's new and high risk, they'll create that as a startup and spin that out so that it's not being done under the brand that the University of Kentucky brand or whatever the corporate brand is that has certain equity and standing in the mind of the customer. They don't want to potentially tarnish the brand of that company if that startup or an early stage technology, something doesn't work exactly right. They want to isolate that off and under a separate brand. So that's another thing that we often see and that we need to do from the university's perspective, because the university doesn't have the ability to do certain things under its mission. We need to move it out into a separate entity so that we can do those things. So at a high level, when we're talking today, this is the purpose, the track of the startup that we're really looking at as we're moving forward. So just to recap here, so these are scalable venture track startups. They're startups that are likely to exit via acquisition. There are startups that are likely to enter into strategic partnerships with national or international corporations. So these would be the types of arrangements that would involve legal counsel and other things at the corporate side. So it wouldn't just be a purchase agreement where they're buying a product from you, but it would be a much more in-depth type of a partnership relationship. And then also those that are pursuing SBIR and STTR grants, because those companies that are pursuing SBIR and STTR should be doing all of these things above. They should be scalable venture track startups. They should be planning to exit via acquisition, and they should be planning to enter into these types of strategic partnerships. For those types of companies, LLC is not the answer. For those type of companies, you definitely want to be looking at a C corporation and ideally a Delaware C corporation. We're going to talk about why you want to do those things. So why might you want to think about an LLC? If the C Corp or the Delaware C Corp is the right entity selection, then why does LLC even exist? Well, there are places where LLCs are the right entity choice. And we're going to talk about that a little bit going forward. But typical types of places where you might see an LLC used would be if you wanted to start a local business that's a restaurant, maybe a retail business of some kind. You want to provide some kind of services via a small business. Maybe you're starting a consulting firm. Maybe you're buying some real estate, doing some investment in real estate. Maybe even you're investing in a startup. Believe it or not, people that are investing in startups do that often through LLCs, even though the LLC needs to, or even though the startup itself needs to be the Delaware C Corp. And other types of things where you might want to think about that would be cases, and all of these are examples of cases where you're planning to have a single owner and no changes to the ownership. So those types of things tend to be where the LLC may be a very easy choice. You can certainly have multiple owners under an LLC, and you can do changes to ownership, but as we'll talk about, that becomes much more complicated in the LLC structure. So just some background here on LLCs, S Corps, B Corps, C Corps, and Delaware C Corps. So we'll start off here with just some high-level definitions. So all of these entities they're all legal entities. They're all corporations that are intended at a high level to provide a level of financial and legal liability protection against for the owners of that company. So it separates and shields those owners from liability. So all of these different entities do that. The differences between these tend to come down to things like the purpose of the entity, why you're forming the entity, the type of governance that is going to be provided around that entity, and the legal backing and infrastructure that requires some of that governance, and also the tax treatment behind these. We're not going to talk in great detail about the tax treatment today, but the tax treatment really influences a lot of the things that we're going to talk about today. So at the high level, an LLC is kind of it's a hybrid organization. It's governed by state law, and every state is different, but it's governed by state law, and it's a hybrid between a corporation and a partnership or a sole proprietorship. So that's kind of what the LLC looks like and how it feels in the law. Corporations, by contrast, are largely governed by federal law. So corporations, the minimum governance requirements and how these corporations work is really defined by federal law, and it's governed by the SEC, Securities and Exchange Commission. So what you'll have, there's three types of corporations. There's the C Corp, which is the standard corporation. There's a subchapter S corporation. That's really not used as much anymore. You don't see those as much anymore. It's really been replaced largely by the LLC. And then you have the B Corp, or Public Benefit Corporation. I'll talk a little bit about that. And then the Delaware C Corp, all that is, it's a C Corp, just like any other C Corp. It's just formed in the state of Delaware. And we'll talk about why that is or can be important. So in terms of LLCs, the concerns with LLCs and why LLCs are a bad choice in terms of an entity selection for a scalable venture track startup, there's a few reasons here. One is, again, they're governed by state law, and each state has different law around what that LLC is and how they're treated, how they work. So as you're doing business with a large multinational, international corporation, the LLC and the fact that it's governed by state law is going to create friction. So as their legal teams are going through and doing, for example, doing legal review of a contract, they're going to have to do that legal review of a contract in view of Kentucky state law if your LLC is a Kentucky LLC. Well, they probably don't know Kentucky state law, so they're going to have to hire legal counsel in Kentucky to do a review, someone who's familiar with Kentucky state law to do a review. So what it's doing at a time when you're trying to get the deal done, you've done all the work, all the hard work to get this deal done, you're adding friction to closing the deal. At the very last stages of the deal, you're adding friction, which is not something that we want to do. Also, in addition to the fact that you have the legal counsel and the different law in every state, you also have state-specific case law. So when attorneys are rendering opinions and helping people to understand, what we can do, or we could do, or we should do, or we shouldn't do, a lot of times those opinions are not based on the law as much as they are interpretation of the law, which is documented in various case law. So historical case law provides the underpinning of these decisions as to why they opine that this is good to do or not good to do. And if there's state-specific law and they're having to look at every state to find the law, then there's a chance that, number one, there may not be very much law, or maybe the laws in Kentucky or the case law in Kentucky hasn't dealt with a certain situation. So those are all things that just kind of add to this friction and make it higher risk as you're trying to engage with these corporations. Another concern with LLCs is the pass-through taxation, which we'll talk about in more detail. And as a result of that, and maybe for other reasons too, we'll talk again about this, but most venture capitalists will not invest in LLCs. So this is something to keep in mind. If you're a venture track business, your early investors want to see that you're going to be able to raise that next round of investment. You certainly want that company to be able to raise all the rounds of investments that it needs to raise in order to get to the exit, but you're going to run up against a wall where your venture capitalists will not be able to invest because it's formed as an LLC. So why is it that investors and LLCs are problematic? Well, it has primarily to do with the pass-through taxation. So for VC funds, so venture capital, this is your Series A, B, and so on. So these are later stage capital. So those groups are typically with venture capital with very large venture funds that the investments are made out of. And those venture funds are typically made up of what are called LPs or limited partners. Those LPs could be individuals, family offices, or it could be things like endowments or other types of entities. And in some cases, those LPs do not have the ability to accept the pass-through income that comes off of an LLC. So because those LLPs are part of the fund, they say we will not or we cannot invest in an LLC because we can't pass these pass-through income back to our LPs. And so for tax exempt organizations and foreign organizations, these are particularly a problem. If you're not talking about a venture capital fund, it's the reason the pass-through taxation is a problem is it represents risk. Investors view everything through the lens of risk, and this is just one more type of risk that the investors are seeing. So what do I mean by that? Well, if an investor invests in your company, and let's say they invest $25,000 in your company, and they're a shareholder in your company or a unit holder in your LLC, that investor cannot file their personal taxes until your business files your corporate taxes and you generate a K-1 to pass that tax burden or benefit back to the investor, back onto the unit holders. So if your company, for some reason, doesn't file your taxes on time or generate your K-1s on time, then those investors are not able to file their personal taxes. That's a problem. And it would not be unheard of if you're an investor doing a lot of investing to run across a startup here and there that doesn't do such a great job with corporate governance and managing the books and managing the business. Next thing you know, they're not filing their taxes, and now I can't file my personal taxes. So there's risk. Take that a step further. If you are an investor that is organizing venture funds, so you're the general partner and you've got a bunch of limited partners that are putting money in, or if you as an investor are trying to share a particular opportunity with a bunch of golfing buddies or whatever, you do that through what's called an SPV or a special purpose vehicle. Now your investment doesn't produce that K-1. Now it's not just you that can't file your taxes, it's you and all of your friends, you and all of your LPs, and they're all coming to you. So this is embarrassing. It leads to credibility issues for you. So from this perspective, the pass-through taxation just creates a lot of friction in the investing process. It's yet one more reason that an investor might not want to invest in your business. From a long-term perspective, it also has limitations in terms of the company's ability to grow and exit. And so investors, they're investing with a long-term outlook. They're investing their money with the intention of this company growing and exiting. And for that reason, it's really important for them that the structure of the business is set up to be able to sustain that growth and exit. All right, so by contrast here, the C corporation is really designed to be advantageous for managing multiple shareholders, multiple classes of shareholders. So you start to get into what's called preferred equity and things like that. So as investors and later stage investors are coming in, they're investing in these more complicated structures, and the Delaware C corporation is designed to be able to do that. And so by doing that, it positions the company for future growth and exit. So why Delaware? The Delaware C Corp, well, Delaware is, for many, many years, has been the place that most people, large corporations, file their C corporations. And so as a result, there is a huge body of case law. There is a wide understanding among attorneys on how to do corporate law. It is all based around Delaware state law related to C corporations. So everybody speaks Delaware C corporation law. So if you're a corporation and you're entering into business with a different corporation and they're filed as a Delaware C corp, and the contract is going to be governed by the laws of Delaware law, then it's going to be very straightforward and frictionless for you to be able to negotiate and do the legal review around that contract. Again, substantial library of case law, and because of this, it makes transactions flow much more smoothly, or at least it reduces the friction that we might otherwise create. Still going to have to negotiate everything else, but at least this won't get in the way. All right, so hopefully I've given you lots of good reasons why you should choose the Delaware C Corporation. So if that's the case, why do you continue to hear around the water cooler that somebody just formed their LLC? Why might they even go to a legal professional and get advice to form an LLC? Let's dig in and look at some of those common reasons. So the first one is, and from the entrepreneur's perspective, one of the things that I hear all the time is, well, it's cheaper to start an LLC. Well, yes, technically that's true. I can go on to the Kentucky Secretary of State's website. There's a link in the left-hand bar to form the LLC. I can click that. I can fill out a simple web form. I can pay them $40 and I have an LLC. So quick and simple. What I don't have with that is the agreements that govern how this entity is going to be run and managed, which positions it for problems. So if you're dealing with a single member LLC, something like a consulting firm, something like something simple like that, where you're not ever planning to sell it, you're not ever planning to have multiple owners, it may be okay. I'm not saying it is okay. It may be okay for you to have an LLC that doesn't have all of these agreements behind it that you form for $40 on the Secretary of State's website. If you're doing a complicated business like what we're talking about, where you're doing a scalable venture-backed startup that's positioning itself to work with corporates and to exit via acquisition and all these types of things, it is absolutely not okay for you to just go to the Secretary of State's website and create your business and pay your $40 and be off and running. So there's a right way and a wrong way if you're going to choose an LLC. The right way is that you would go to an attorney and you would draft an operating agreement that would be very specific to how your LLC is going to run, to how your membership is going to be managed, and all the particular cases that might take place over the course of time with operating your LLC. That is not going to be cheap and easy. You're going to pay an attorney to sit down and write a fairly complicated legal document. And it's going to be largely customized to you. And so that's going to be expensive. The wrong way to do it is to either A, not do it, or B, to go online and download an operating agreement for an LLC and not get legal counsel. And long term, in the end, that is going to be much, much more expensive. That is the absolute wrong way and highly not recommended. By contrast, with C Corps, the structures and all of the documents around forming these structures are largely templatized. So it's fairly straightforward when you go to an attorney, a startup attorney, tell them you want to form a Delaware C Corp for the purpose of being a scalable venture-backed business. They're going to know exactly what to do, pull those templates off the shelf, fill in a couple of blanks, and you should be good to go. All right. Myth number two, LLCs are easier to manage. So again, it could be from a governance perspective that an LLC may not have the strict governance requirements that a corporation may be required to follow. However, if this business is going to have multiple owners and it's going to have investors, it's going to have various shareholders, various entities, corporate governance is something that you're going to have to do. You're not going to be able to skip corporate governance and operate a complicated business, whether it's an LLC or whether it's a C Corp. It's not going to be easier to manage. You're going to have to practice corporate governance. So the other thing that I'll say on this is, again, back to the mission of the startup. The purpose of the startup is to take a technology from point A to point B, to create value from point A to point B, and to exit via acquisition. When you get to point B and you're trying to exit via acquisition, if you haven't practiced corporate governance, it doesn't really matter what your technology has done. if your business hasn't been properly managed, it could trump in the legal reviews. It could trump all the positive things you've done on the technical side, and make it to where the potential acquirer or the potential business partner or potential investor just chooses to walk away. All right, avoid double taxation. So this is another big reason that we hear people say not to use C Corps. So let me just explain quickly how double taxation and where this comes from. So with a C Corp, that does not follow pass-through taxation. So what that means is that the company pays its own taxes. If the company does its and files its tax form and it says that the company owes X number of dollars in taxes for the quarter or for the year, then the company is responsible for paying that. That tax burden is not passed on to the owners, the shareholders of the corporation. The company pays its own taxes. So what will happen is if the company is profitable and it's paying its taxes, then whatever's left over from proceeds after paying its taxes, it may distribute out to shareholders as a dividend. And then when you as a shareholder receive that dividend, you get taxed on that dividend a second time. So the income is taxed once at the corporation and once at the shareholder level on the dividend. So that's a double taxation. That's where that term comes from. Well, again, back to the mission of what we're doing, of taking a business or an early stage technology from point A to point B. If we're in a position where we are pre-revenue or early post-revenue, we're probably not going to have a lot of taxes that are due. So this avoiding double taxation really may not be much of a gain because we're not going to have a lot of taxes that are due anyway. If we think about it from the perspective of the reason to do an LLC is to avoid the C corporation and to avoid the double taxation, but you're going to take investment and the investors are going to require you to form into a C corp or to convert to a C corp. Well, you're going to have double taxation anyway by the time that this is a concern. So you haven't really avoided anything initially by setting up as an LLC, avoiding quote unquote double taxation, because you've already had to switch to a C corp by the time you get to the point where taxation is even a concern. And again, your investors, later stage investors, are going to require the C corp in order to invest. For deep tech startups, oftentimes you're not going to see hardly any impact from this double taxation issue. For deep tech startups, oftentimes the company will be acquired at the point of either pre-revenue or after early revenue. So again, very minimal taxation that's even on consideration for a deep tech startup prior to the point that the acquisition takes place. So we're really not worried about the double taxation. The biggest key that I would say here is we need to remember the mission of the startup. The mission of the startup is to take this technology and advance this technology, de-risk this technology, create value behind this technology for the purpose of an exit. It's not intended to chase tax breaks. So let's keep the vision in mind and make sure that we're making business decisions based on the mission of the business and interpret those business decisions and interpret these choices based on the mission of the business and where this business is and the type of business that it will be engaged in. All right, here's another one that we hear all the time. My investors want the tax losses. So explain this a little bit. So as an LLC with the pass-through taxation, if the company in the early days is losing money, then what will happen is when it files its taxes, generates its K-1s out to the unit holders, there will actually be a loss that gets reported and passed on to the unit holders, which is essentially they're reporting negative income on their personal taxes. So if they've paid in their taxes, they might get a tax refund, or if they have other taxes, other investments that have generated positive tax burdens and you're giving them a loss or a negative tax burden, then it could offset some of the taxes that they may have to pay based on some of their wins or some of their later stage investments. At a high level, I want to warn you big time. If you have an investor that's putting a lot of pressure on for you to form and choose the formation of the company, in order to chase tax losses or in order to give them a tax write-off, I really want to question what their mission and what their commitment to this company is over time. So first of all, what I would say is the only way that this works is if these LLC if these investors are actually LLC unit holders. And what we see is in early investments, they're typically investments in earlier stage company, earlier rounds of investment typically follow either a safe note investment instrument or a convertible debt investment instrument. We're not going to talk in detail about what those are here, but early stage investors tend to use these types of investment instruments when they're investing in startups. So the reason this is important is because if you're a safe holder, if you've made an investment via a safe or an investment via a convertible note, you are not actually a unit holder of that LLC. So even if the company has lost money, you're not going to get a K1 and not get those pass-through losses. So you don't get to benefit from those losses if you're investing on safe and convertible debt until the point that it converts later, which oftentimes you're going to have to be a C Corp to do that. So it's really only applicable to investors that are coming in a co-founder type of role, that are investing from the beginning, putting money in on a cost per unit basis and become unit holders early on. That's typically not the way startup investing is done. And then again, just the goal here is always, when we're trying to form startups, we're trying to bring on partners, we're trying to bring on investors, we're trying to bring on team members, and equity is changing hands. What we always want to do is be striving towards the shared risk reward model, where everybody wins when the company wins. And if we're chasing tax losses that only really are of value to the investor, then that's creating this immediate split in incentives. From the very beginning, investors are chasing losses. They want this company to lose money, where you as the founder is wanting this company to create value and do other things. You're not worried about you're not in the business of creating tax losses. So you want to have this common definition of success, shared risk reward. So again, it's not wrong to take the losses when the losses are available, but you shouldn't be chasing. That shouldn't be the decision behind it. And if you have an investor that's pressuring you to choose a entity based solely on tax losses, that would be a red flag for me. The other just comment on this is this knife cuts both ways. It's not just the losses that get passed forward, it's also the gains. And so you could have pass-through gains coming through this LLC that you as a unit holder are going to have to report on your personal taxes, and you could end up owing taxes that you didn't expect because you have a K1 that has a taxable gain. So for those of you that are pursuing SBIR, I would particularly caution you on this, because in the normal day-to-day operation and execution on your grants, you can come up in situations where you have taxable gains on paper that are not actually what you think of as a profit. You talk to your attorney at the end, or you talk to your accountant at the end of the year, and they say, well, you have a taxable gain of X number of dollars this year. You're like, oh, really? I didn't know that. And so now they're going to give you a K1 and you have no cash to pay these taxes, but yet all of your unit holders are responsible to pay those taxes. So the types of things that I'm talking about here could be, let's say you get a new SBIR grant and you buy some computers, maybe you do some leasehold improvements on a business, all those things that have to be depreciated over time. Those things are going to create a paper gain from a tax perspective that you're not now going to have the cash to be able to pay those. The other thing that can happen is a lot of the SBIR programs require you to carry some amount of debt because they do the SBIR program on a reimbursement basis. If you're in a case where you're doing that, you could have more or less debt depending on where you are at a particular moment in time. And that could, if you have less debt one period than you did another period, that's considered a taxable gain. So again, that could be a warning. So just work very closely with your accountant or your attorney. And particularly for those of you that are doing SBIR, I highly recommend you work with an accountant as well that has SBIR experience, in addition to attorneys and accountants that have startup experience. Okay, another thing that we hear is, I'll do my LLC now and I'll convert later. This is probably one of the most common things that people want to do. They want to take the advantages of the LLC. They want to outsmart Uncle Sam, take the advantage of that LLC, and then when the time comes that they need to convert, they'll do the conversion. So a couple of things to keep in mind on this. First of all, conversion from the LLC to the C corporation is a taxable event, and depending on the valuation of that LLC at the time of the conversion, you could end up with a big tax bill. So you need to be working with your accountants and your attorneys and be very cognizant of a potential taxable event on the conversion. So this probably won't apply to most of you, but just keep that in mind and work with your professionals on that. The second thing is, from a logistical perspective, and I'm telling you, I've worked with several companies that have done this. This is logistically extremely complicated, extremely costly, and extremely time consuming. I'm not going to go through all the details here, but I've listed out a lot of the things that you have to do. When you're converting from this LLC to the C Corp, there are two different entities. So whatever you've done under the LLC has to be redone under the C Corp in terms of relationships, agreements, accounts, policies, government registrations, tax IDs, everything that you've done under the LLC, you have to start over again under the C Corp. So you can obviously transfer your IP and all that kind of thing. But a lot of these other things they can be transferred, but they're very, very time consuming. So just keep in mind, from a logistics perspective, this is not just flipping a switch. And the last thing, I'll talk in a minute about this 1202 tax exemption, but I just want to make a note on here. We'll pin this until a later slide, that if you're going to do the LLC now and convert later, that your 1202 clock doesn't start until you convert. All right, and then finally, what if you've already formed as an LLC, you're already doing business as an LLC, and now you realize, oh boy, we need to convert. What's the advice on that? Well, my advice is convert ASAP. So you want to avoid creating potential value in the LLC that could create a taxable event. And again, work with your accounting and legal professionals on that to understand the timing on that, what types of things for you could create those types of taxable events. You do want to start this 1202 clock running. Again, we'll come back to that in a second. But you also want to stop loss on the work that you're doing under the LLC, knowing that you're going to have to redo some portion of that to transfer it from the LLC to the C Corp. So every new agreement, every new policy, every new thing that you do under the LLC, there's going to be some amount of effort required to transition that, to redo that under the new corporation. If you have formed your LLC for the purpose of pursuing SBIR and you're active in the SBIR process, a good time, if possible to do this, a good time to do it is between the phase 1 and the phase 2. So complete your work on the phase 1 and apply for the phase 2 under the C Corp. That's a good time to do it. If you have multiple SBIRs, that may not be possible. So you'll have to look at the details of your particular circumstance, but work on timing that, try to minimize your pain as much as possible. All right, I want to talk about a couple of special topics and then we'll close out, be aware of time here. So the first topic, as I've alluded to a couple of times, is this 1202 tax exemption. So we talk a lot about, in Kentucky, we talk about our state tax credits for investors that are designed to incentivize investors to invest in and take risk in startups. Well, this is a federal program, a federal tax incentive program to incentivize investors to invest in deep tech startups and scalable venture track high risk startups. So what this program does is it provides up to $10 million in tax-free gains from the exit or stock sale of a high-risk company. And so that 10 million, the first 10 million in gains will be exempt from federal taxes. This is qualifying C corporations are eligible. The type of companies that I've described here that are the focus of this presentation would be qualifying entities. So if it's issued as a C corporation, doing the business that we've talked about, It would be an eligible corporation. Again, talk with your attorney to make sure. But the key here is that the stock must be held for at least 5 years in order to qualify for this tax credit. So if you're, remember back to our definition, it's a temporary organization. So typically 3 to 7 years kind of time frame is what we're looking at on a business like this. So if you've done the start as an LLC and convert, you've already eaten up a lot of that 5 years. You could end up exiting the company after 7 or 8 years and not be eligible for this $10 million tax credit because you started as an LLC and then converted later to your C Corp. If you start as an S Corp and switch from the S Corp to the C Corp, you're never eligible. And just a note here about investors, again, that are investing in safe or convertible debt instruments, their clock on the 1202 exemption doesn't start until those instruments convert. So that's when they're actually issued stock in the company. So that's going to happen usually at a later date. And so for your investors, this is something that they want to be aware of, and they may, choose or want to do a priced investment round as opposed to a safe or convertible debt because they can get that 1202 clock started to their $10 million tax credit. All right, I also get a lot of questions about B corporations. So B corporations, I alluded to it at the beginning. So these are public benefit corporations. Just really quickly, a C corporation, the board and the executives in a C corporation have a fiduciary responsibility to the shareholders to maximize share value. And so if their job is to maximize share value, then you could argue that them doing other things, other bottom lines, other things other than maximizing profits, that they're not doing their fiduciary job. So the B corporation was created as this public benefit corporation for the type of company who says, I do want to make money, but I also want to do social good. And so they define this metric about their social good language, and then they have what's called the double bottom line. Not talking good or bad about B Corps, but what I will say is from an investor perspective, investors view B Corps essentially as a nonprofit. So they're not viewing these as scalable venture-backed startups. So if your goal is to be a scalable venture-backed startup and you have a technology that is in line with a scalable venture-backed startup model, and you plan to secure investment as a part of that model, the B Corp is probably not the right structure for you. So there, I would encourage you to consider, again, the Delaware C Corp for that. I've outlined a couple of strategies here. If you do want to have that double bottom line kind of mindset, and there are certain things that you might want to do under a nonprofit side that you think, well, these would be advantages of the B Corp. How could we do this if we're following a Delaware C Corp model? Well, one strategy is to create 2 sister organizations. One would be the scalable venture-backed startup, and then the other would be a foundation that is an associated foundation. And so the 501c3 foundation can now do the nonprofit aspects of the overall opportunity, while the Delaware C Corp is doing the scalable, venture-backable, exitable aspects of that. So the one note that I will have here on this is that for any concern about a C Corp being hard to manage, the 501c3 is much harder to manage. So that's something, just be prepared. 501c3s are intentionally complicated. The IRS doesn't want to give tax-free treatment to anybody. So they make them difficult. And so just understand you're signing up for that. But this is a mechanism you can do it. The other way you could do it, if you don't want to create the 501c3 and the logistics associated with that, is to find somebody in a 501c3, an existing 501c3 that shares your mission, and partner with them. And you may be able to do all types of strategic partnerships or other things like that. They could become a channel partner for that kind of a relationship where they're selling part of the product, you're providing a service to them that they're selling. You could create a branded version, a white labeled version of your product that would be unique to that nonprofit mission. They could apply for grants. You could collaborate together under grants if you were trying to seek funding that was only available to a 501c3. So those are some types of things that you could do. All of those things could be done in either of these two models. But if your goal is to attract investment and to exit, I really don't recommend the B Corp for that. All right, a few closing remarks, and hopefully we have some time at the end for questions here. As I said at the beginning, I really highly encourage you to get a startup attorney to help you with all of this work. Obviously, we talked about a lot of very deep, very complicated things today. You need a startup attorney who can help you, someone who is a very experienced professional that can help you do the things that you need to do. I strongly encourage you not to do the DIY model of either doing it yourself or downloading things off the internet. I strongly encourage you not to go to a friend or family member or somebody like that who is an attorney and ask them to just help you out forming your company. And even if you were to go to a traditional business attorney that is not a startup attorney, just beware that they may not really be the right choice either. So being a startup attorney, it's a very unique skill set. It's a very specialized type of work, working with scalable venture-backed startups. They are very much in demand, and it's worth your while to find people that practice just this niche of corporate law. So the types of things that you're looking for on their websites and other things that they would be doing, helping you with entity selection. But again, they've got 20 years of experience or 10 years of experience working with other companies that have been down the road that you're in, that they can tell you all of these pitfalls that I'm trying to educate you about today. They can talk to you about that because they've worked with other clients that have had these types of problems. Working with employment agreements in a particular, the employment agreements are different when you're talking about these types of companies. Managing cap tables that are constantly changing as you're issuing new stock and bringing on new people. As the Office of Technology Commercialization, we want your startup to be represented by good legal counsel as we're negotiating license agreements. And we have seen when our clients are represented by startup attorneys, people who have the specific experience that know what it's like to negotiate these types of agreements, the process goes much more smoothly. People that are familiar with investment instruments and terms. So as you're talking with investors and they're proposing terms back and forth to you and negotiating terms, you need someone in your corner who understands all of these terms and the implications of why these terms matter, what you should do, what you shouldn't do, where you can give, where you shouldn't give. And you need somebody that does this every day. Stock issuance and managing different classes of stock, it's very unique to this type of a company. So you need people with that kind of expertise. Oftentimes your attorney is going to be be in your board meetings. They won't be a member of your board, but they will take the minutes of your board as a part of this corporate governance. And then also managing taxes. As you've seen, taxes are a big deal in these companies, and having that experience of understanding how taxes work is really critical. The other thing that I'll say here is when you get into forming a company, whether it's you choose to go LLC or hopefully you choose to do the Delaware C Corp, there are very standardized documents around all of these activities, around all of these things that need to be done. And what I encourage you to do is follow the standards. You don't want to be in a situation where you have unique documents where your attorney has done creative writing exercises in your corporate legal documents, because what's going to happen, these documents are going to be reviewed during the diligence phase of whatever type of an arrangement you're trying to enter into, whether that's closing an investment round, whether that's closing an acquisition, whether it's setting up a strategic partnership. And when you get into that legal review and it's your attorneys versus their attorneys, and all of a sudden your corporate documents aren't what they expect to see, it's either A, going to be extremely expensive because you're going to have attorneys redlining, redoing your documents to put them back into standard format, or more likely people are just going to walk away. So it's really important that you think about the fact that as you're going forward, in the startup and you're creating the value in the company by the technical work that you're doing, by moving this technology forward, you're de-risking the technology. You really have to be doing in lockstep the business side of the work, so that when you get ready to exit, you get ready to enter into these agreements, you get ready to take on investment, that your company is positioned to properly be able to do those things. So using standardized documents and avoiding unexpected things will go a long way in that. And finally, I just wanted to say just a quick note about the role of accountants and attorneys. As you as a founder working with your board, as you as an executive of a company are managing your company, your attorneys and your accountants, they're consultants. They're highly paid, they're highly knowledgeable, they're experts in their field, not in any way diminishing the value that they bring. But it's ultimately your job as a C-level executive or a board member of a company to make those business decisions. Your job as a C-level executive or a board member as a part of corporate governance is to gather advice from accountants, attorneys, and many others, and to make hard decisions, to make judgment calls based on your specific situation. Your accountants and your attorneys can only provide advice which is as good as the information that you've given them. If you're going and sitting down and talking to them and telling them things that don't make sense for the type of company that you're planning to run, or you don't have a clear vision in your mind of the company, then what the trajectory and the purpose and the mission of the company are, then their ability to provide good advice is limited. So we're always here to help you form those types of discussions and to form those types of questions and to think about those types of things as you're moving forward. And I hope that this presentation today has helped with some of that. So with that, open the floor with a few minutes left for some questions if anybody has any.
Thanks, Eric, for such an informative presentation on whether or not to choose LLCs and why you shouldn't. We have a couple of questions here from our attendees. One is, does OTC help faculty innovators when they're wanting to do a startup? And if so, how should someone make that request?
We absolutely do. So we have a plethora of programs where we can provide support. If you have a technology that's been disclosed to the office, so if you're a university innovator, you've disclosed technology to the office, you're automatically going to interact with our commercialization team. And we are here to advise and to help you with these types of issues, developing business models around your technology, understanding what that trajectory of that company is to go that point A, point B. What is the mission of the business? How do we create value in the business? What types of things can you do that are going to position you to be able to attract investment? How to get SBIR? All of those things are things that we help with every day, and certainly happy to help with these types of things as well.
Thank you, Eric. And the last question is, does the $10 million tax exemption from a sale apply to each investor, meaning 10 million each, or is it the total for the entire company?
My understanding is it's 10 million per shareholder. So I'm not an accountant or an attorney, and I recommend that you talk to one. And you can also, I put a link in the slide there to one reference, but if you Google that 1202 tax exemption, there are a lot of references out there about that. So that's something that you can get a lot of information about, but your startup attorney, your accountant should be able to help you with that as well. But my understanding is that it would be per shareholder.
Thank you, Eric. Just want to thank everyone for joining us today for this topic. Again, we have recorded this and we will be emailing you a link, and it will be on our YouTube channel. We have a couple of upcoming events next week on September the 22nd, 4 to 6 p.m. is our annual celebration and recognition of UK innovators, Patent Palooza. And in October on the 13th, we'll be doing a webinar on everything you need to know about agreements. You can register for both of these events on the Office of Technology Commercialization's website, and we look forward to seeing you there. Thank you and have a great day.